it was obviously a very good year for every stablecoin issuer. Anyone who had a live stablecoin in market, for the full year of 2025 did very well. The fact that DAI is technically the only one down, which I guess USDS and DAI are kind of the same thing. So I would put that aside. Everyone grew. Everyone grew in 2025. But then to see that USDT, added, almost as much supply as everyone else combined. And so adding close to $50 billion of supply in a year, that is extremely impressive at just the pace that they're growing at the size that they are.
Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of tokenized real-world assets. My name's Simon Taylor. I'm your host for today, author at FinTech Brain Food and head of market dev over at Tempo. And back with me once again is my colleague, my friend, my co-host, Kai Sheffield. How the heck are you, sir? Can you say the word co-host?
I am fantastic. I'm excited to get into some on-chain data. There's so much that you can learn from the data. And so this show, shout out to Artemis and team, has been fantastic. It's fun to get on and learn from them.
Definitely. We are doing a 2025 year in review, and of course we had to have the Artemis guys come and do that. So first up, of course, is Anthony Yim, co-founder of Artemis Analytics. How you doing, Anthony?
Wonderful. I'm actually burning up with a fever, but the show must go on, actually, and I'm still excited with a fever.
But that's how hot stablecoins have been in 2025. Your body knows it. I'm glad it could get with the program here. Also joining us is Andrew Van Aken, Chief Data Scientist at Artemis. How you doing, Andrew? Have you got a fever or?
No, but that's a two-step promotion from junior data intern to Chief Data Scientist. So I'm happy to take it, anytime.
Yeah. I just read what's in the notes, man. You could have edited those a few seconds ago and I'd have no idea.
Performance review time.
I am Ron Burgundy over here, the Ron Burgundy of stablecoins. I need to remind everybody, of course, that views and opinions of contributors today are their own and might not reflect those of companies they represent. Please don't take anything we say as tax, legal, or financial advice and do your own research. Before we get into the review, though, we just have to hear a few words from our sponsors. This episode, if it isn't already obvious, is sponsored by our friends at Visa, the leader in digital payments. Visa's Tokenized Asset Platform, or VTAP, uses smart contracts and cryptography to help banks bring fiat currencies on-chain, whether it's launching a stablecoin or deposit tokens or something else. VTAP allows financial institutions to issue fiat-backed tokens, improving financial efficiency and enabling programmable finance. Check out the links in this episode's description to express your interest in VTAP. This episode is sponsored by Privy, a Stripe company. Stablecoins can't go mainstream without simple and secure wallets. That's where Privy comes in. Trusted by more than 100 million accounts, Privy lets users launch wallets instantly with familiar logins like email or social. It's consumer-grade user experience with enterprise-grade security. Start building with Privy. Learn more at privy.io. Tokenized is also sponsored by Fireblocks. Fireblocks is the stablecoin infrastructure of choice for global businesses from Visa to WorldPay to Bridge to Revolut. With over $100 billion in monthly stablecoin volume, Fireblocks powers stablecoin strategies at scale with infrastructure that enables PSPs, fintechs, remitters, and banks to issue, move, hold, and manage stablecoins. It's all done securely at scale with secure built-in compliance. With Fireblocks, you get complete control to build your own stablecoin orchestration layer, create payment accounts, manage liquidity, and access on and off ramps in over 60 currencies. It makes it easier for you to build and scale and expand your business globally. Learn more at fireblocks.com. Thank you so much to our sponsors. Now, it's time for me to hand over the hosting duties to the one and only Andrew Van Aken, the junior data scientist, intern, coffee maker of the day himself. Take us through the data. Give us a data-driven review on 2025. Let's do this.
Well, we make good coffee at Artemis too, so nothing is we don't take anything for granted. So starting off, I wanted to get everyone's kind of just general take on 2025, but I think the the slide that just most exemplifies stablecoins this year is the number of stablecoins above $10 million in supply is now over 140. And we started the year at roughly 60, and now we are just well on our way. Gentlemen, did you, and coming into 2025, did you think, yeah, I think we're going to have almost twice as many stablecoins as we did at the start of the year? And I guess actually, thinking about 2025, what are your general thoughts here of obviously everyone is launching a stablecoin now, but it certainly is, the data shows it. Literally everyone is launching a stablecoin. Kai, we'll start with you. Does this jump out at you? Does it surprise you?
Yeah. So when I saw this chart, I had a few thoughts. One, very consistent with our theme of everyone wants a stablecoin, which we've talked about over and over on the show, and sometimes whether or not it makes sense. And there's the debate around when does it make sense to create your own versus to partner and use an existing one. I think the other thing is, a lot of the stablecoins that have been announced in 2025 haven't even actually gone live yet. And so then I was like, wait, there's Western Union, there's the Tether USAT, there's Klarna USD, there's just announced, there's FI USD. And so we're already seeing 140 that are over 10 million that are live. And then there's this whole host of ones that are announced but not live. And then it's likely there's a whole nother round of stablecoins that are in progress being worked on that are not announced or live. And so I think it looks like this chart is really just beginning to bend, and that you're going to see hundreds of stablecoins that are live. And I think the other question I had on the data when I saw this is, what percentage of these are USD denominated of the 140 versus non-USD stablecoins, which I think is another big question and theme trend that we should talk about. And then are you only counting fiat backed, or does this count algorithmic backed? Because then if it's if anyone can create some type of crypto collateralized algorithmic thing, then you could see these DeFi protocol approaches get launched much faster without having to have a traditional fiat reserve. So any clarifying pieces on what the 140 number includes? And then Simon, curious to your reaction as well.
I have no clue what the 140 includes, so I would really hope you might have a view there.
Yeah. So the 140, it's actually I would actually throw it back to everybody else. Do we actually need to rethink what is a stablecoin? Because here we are counting algorithmic, we are counting fiat back as well, like things like Athena. We do count Falcon Finance, et cetera, but we also count the PYUSDs of the world. But what I think we're starting to run up against is, do we start counting these, tokenized deposit money market funds? Do we start counting gold-backed stablecoins that are using interest rate hedge measures? Simon, you seemed enthusiastic there. Do we need to rename stablecoins? Do we need to call them something else?
That was exactly what was going through my head. I actually think we call a lot of things a stablecoin, or at least the market does, that are not stablecoins, right? And if you listen to Guy at Athena, he's quite clear that he's building collateral. And that USD is a form of collateral, and that it can be used for those purposes, but he doesn't expect you to be spending this every single day. And so that's one category of thing, of this on-chain collateral that is pegged towards a dollar. And really, the stablecoin is a receipt for some sort of reserve or some sort of access to that reserve. Then you've got the traditional fiat-backed, Circle Tether types, but you've within that now got this second category of M0, Agora, and what Bridge is doing, letting anybody be an issuer of USD stablecoins, but underneath it, there's this pool of stablecoins that it's all backed by. It's backed by the same reserve. So what's that? Is that the same thing? Is it a different thing? Because it's allowing you to have this branded token, and it's allowing you as a non-stablecoin issuer to potentially collect some of that yield and represent it as your token. That's really cool for treasury management or loyalty use cases. But that's not the same thing as Circle and Tether. and what they're doing. So it's like this separate category of thing. And then there might be a whole bunch of other things that come off to the side of it. So if we go back to the original question, did I expect this at the beginning of the year? No. But as I think about what the key B2B use cases are and a lot of the interest around corporate treasury, you can see there's some value in branding this thing. You can see there's some value in just managing my own treasury. Like if somebody ran a corporate treasury and they had a bunch of bank accounts and they had a bunch of T-bills and a bunch of repo, and then you gave them a new technology that allowed them to collect the yield for that and move it cross borders 24/7, they'd want that thing. We happen to call that thing stablecoins, but they want the yield themselves because it's their own funds, it's their own liquidity. So of course they want the yield for it. This is just the token that represents their ability to do that thing that they wanted to do in a slightly better way. So yes, I think there's an issue with the naming, and maybe we need to subdivide those just to make the whole world a lot more confusing. But I can see a slide in my near future with some sort of diagram where I might have to make this. What say you? Is that how you categorize them?
Oh, a little 2x2, if you will.
A little 2x2.
I was just going to add that you all should confirm, but like, shout out to our data team, Tim and Noah. I'm like chatting them on the side of like, it looks like, they're, according to them, 93% of stablecoins above 10 million are USD. And so only 7% of this are non-USD. So that will be really interesting to see how that evolves, if that number increases over time.
Yeah, Anthony Yim, I'm actually going to ask the question you asked me last night in frantic preparation for this. If every major bank issues its own proprietary tokenized deposit, are we just recreating the same system we already have, but on a blockchain, I will say?
Ooh, I have opinions.
I don't think that's a bad thing per se. I don't know. It's not. I kind of think so, but at the same time, I think having been in startups for many years now, I think I have a tendency to underestimate how creative people are, and I think and so I'm pretty optimistic that it's still a net positive outcome. But I do think that is actually what's kind of necessary in the beginning, right? Like when we first started Artemis, it's just crypto was like the absolute Wild West. Like it was unimaginable for me to think of real capital coming on chain. But here we are in 2025. We have Simon has a new job at Tempo, and one of the largest, most respected, Stripe being one of the biggest payment companies in the world. And so I think it's okay that we are rebuilding some of this stuff on a much more efficient rail.
And also, if you go back to first principles, why does that stuff exist? And usually the answer to that is risk. And if you could start again from zero, would you make everything really efficient? Of course you would. But the problem with efficiency sometimes is what happens if the other guy doesn't have the money, and what happens if the counterparty is insolvent? And it's all the edge cases that really are where the cost is in the system. So if we're tokenizing deposits, I feel for the bankless guys sometimes. Shout out to those guys. They run an amazing podcast. But I never felt like we were going to go bankless, because fundamentally the utility of what banks do is the ability to take a balance sheet, to have the lowest cost of funding, to be able to create new money supply and lend it into the economy. And now we've got private credit that also does that, and that could come on chain. But that, from first principles, is a useful function in society. There was just a lot of friction in how we move money, because a lot of the technologies didn't allow us. They were marvels when they were built in the 60s and 70s, but they didn't allow us to settle the money instantly. So we haven't gotten rid of the risk of the money not settling. Sometimes settling it instantly does help, but also that can be very inefficient because you have to pre-fund everything 100%. So how can we have a best of all worlds? Well, deposits could play a useful role in that. So I don't think that it's an or answer here. I don't think everything goes pure stablecoins, because people will want their banks who can lend to them at a lower rate to be able to help them. I don't think everything goes pure tokenized deposits either, because people will want this faster, cheaper, programmable, instant 24/7 rail. So I've been a believer sometimes that these things will actually coexist, because deposits are money at rest. And stablecoins are money that moves. And when you understand that stablecoins can be a really efficient rail for the banks, and that deposits can be a really useful thing for the stablecoin ecosystem, then why can't we all just get along? It's the holidays after all. It's the time to be merry, be around your family. Like, let's not make this a fight. Let's figure out from first principles what we actually need. Can I say? I'll thank you for coming to my TED talk.
No, that's a good segue, because we've gotten through one slide in 10 minutes and we have 30. So if you want to do some quick math there, but it is a very, I will say, it is a very Merry Christmas for two folks here in the stablecoin landscape. Tether has added actually about almost $50 billion in supply year over year. They have so much money they're actually buying football teams now, to quote the famous Pink Floyd. But we also have Circle here also gaining another $25 billion. And so you can really see that this huge growth, and even our friends at PayPal have also added $3.4 billion in supply. That is a 700% increase year over year. So clearly, like I think Kai alluded to earlier, this USD stablecoin demand is really driving things forward. And I want to just jump ahead here to a few slides to show you where the supply is like really growing in terms of low cost chains. And I think I want to spend some time here to talk about it because I think it's very important, because we've seen these chains like Solana, BNB growing incredibly quickly. So Solana's supply has grown 200% year over year. BNB chain has grown 100%. Tron and Ethereum not as much so fast. But I guess my first question over to you, Kai, do you think that we finally have the infrastructure on blockchains to really handle these, very quick, very fast, low cost transactions? Is it finally here?
I think it's good enough. And it's continuing to get better. Like, I think there's the question a few years ago of would blockchains ever scale? I think now you have many options of scalable blockchains to choose from. Now there are different properties and different trade-offs between them. But I don't think that there's anyone that's saying now I can't do anything with stablecoins because gas fees are too high, and there's no option of a lower transaction fee chain. And I think that the debate around payment chains versus general purpose chains, like there's the differences in even optimizing what chains are built for matter a lot. But I think we've made a lot of progress as an industry. Going back, I think the first chart of just, it's amazing. One, it was obviously a very good year for every stablecoin issuer. Anyone who had a live stablecoin in market for the full year of 2025 did very well. The fact that DAI is technically the only one down, which I guess USDS and DAI are kind of the same thing. So I would put that aside. Everyone grew. Everyone grew in 2025. But then to see that USDT added almost as much supply as everyone else combined, and so adding close to $50 billion of supply in a year, that is extremely impressive at just the pace that they're growing at the size that they are. And then I think the other comment on the next chart, by chain, is people have been talking a lot about Tron in the Tron blockchain and USDT on Tron, and I think it went from most people in the US had no idea what Tron was. They weren't using Tron, and then they discovered, it turns out a lot of people are using Tron, USDT on Tron in emerging markets, and then it became this target per se that you have a bunch of chains saying, we want to go and flip that volume from USDT on Tron to other chains. And I think you could argue Tron has been surprisingly resilient, that Tron added $19 billion of supply in 2025. And so it doesn't seem like the effect of transitioning from Tron over to other chains has really happened yet. It's still a big target that people are going for, but Tron is growing. And so I think it'll be really interesting to watch, while the percentage gains are high on many of these new, even lower cost chains, because Tron is not cheap. I think it's a few dollars, for gas now. How sticky this network effect ends up being of consumers that are used to USDT on Tron. What is it going to take to switch them over? And this time next year, will we look back and will Tron print another 20 billion in growth, or will you finally start to see some of its market share eaten into? I think that'll be interesting to watch.
But I think that's why it's like so important that we as an industry need to move away from actually the scalability question. I don't think scale is actually what matters. It's actually like, right, it's like Tron is not scalable, but people use it because it solves a pain point. Like as a founder, it's like I'm always just reminding my team, it's like solve what the customer is asking for. Don't just like optimize some metric that is like sexy, right? And I think this is where like, right, it's like I think Simon in one of his other episodes early in the year was like, hey, like Tempo, we're trying to solve for like all these edge cases that are not being solved for, they're not supported by a generic chain, so that you can actually, it's like offer the suite of services that Stripe offers, right? Like that's why Stripe charges an interchange fee that is like hefty. It's because it solves a real problem. They offer analytics, they offer fraud, they offer a way to refund. All these things are really important, not scalability. Like we've solved scalability.
Yeah, and I think people confuse price and value. And the value of Tron is for people outside the West. That is a way to get into dollars and move those dollars around the world that they didn't have immediately available to them before. And that has product market fit. And I do think there's like two worlds emerging of then people who've come into stablecoins over the past 12 months have probably done so on a fast performant chain in something like Solana for some sort of Western distribution, but for a payments use case. But for everywhere else, it's Tron Tether. And I was just in the UAE, and that's the default. And Anthony, you were talking about being in Hong Kong, and that's the default. And we have to recognize that there are almost these two worlds emerging. And the interesting question is, how do they coexist, and what do you do about them? And I think there's a third question, which is also what happens next, because the stablecoin payments market is a fraction of the overall payments market. It is tiny. So we've got lots of MySpaces here, but like there could be a whole bunch of new chains emerge in 3-4 years' time that go on to dominate because the market is still so small.
Yeah, I think, Anthony, you made this point last night where you were saying like so many chains have pivoted to be almost like payments chains, and new payments have been launching, and yet Tron still gains $20 billion. It's just kind of remarkable to see, just there's so much demand for it that all these chains can just keep adding, billions and billions of dollars.
Can we, real quick, can we talk about PYUSD for a second? Because I think that was another standout from this chart. I guess fastest growing from a percentage standpoint, growing 700% in 2025 and getting to 3.4 billion. So I think that there were some people who were writing PYUSD off or saying the chart kind of went up to $1 billion, it went down. It has had a really strong year on chain in terms of the growth in both supply and transaction volume. But at least from the data, it appears not from the use cases and what you would expect. And so from what I've seen, like where most of the PYUSD supply is actually in DeFi. Looks like there's a lot of it related to Athena. I think PYUSD is being used as some collateral there. There's a lot on Camino, on the lending platform. And so just based on like, at least the data I'm looking at right now is there is more PYUSD in DeFi than there is being custodied in Paxos wallets, which is underneath what the PayPal platform is. And so if you would have told me at the beginning of the year, PayPal's stablecoin grows 700%, but it's not necessarily because PayPal customers or merchants are using it for payments. It's because crypto traders are using it within DeFi. Like that would have been a surprise. And so I think that there's like they've executed well in finding ways to drive adoption in these new use cases. It'll be really interesting to see how they execute within PYUSD being used in the PayPal platform. And so I think that's been the other interesting surprise this year.
Yeah, and shout out to our own show. We had David Weber, head of ecosystem at PYUSD, and I think 2 weeks later, the supply increased by 2 billion. So, we're not looking for attribution, but correlation and causation are pretty tight there. Anthony, I mean, you one of the founding engineers at Venmo, and what do you think PayPal needs to do to drive usage on the customer side and really increase retention of a lot of these customers?
I think they should go on a buying spree. They should go buy one of the. I mean, so Venmo was acquired by PayPal because we had we cornered the millennial market, and like Gen Zers weren't even 18 yet at that point. So but they bought Venmo to get access to a whole new set of users that they have that were not using PayPal because they were too young when the .com bubble was happening, and now I think they should go and buy like a Re.Pay or something, right? Like a Re.Pay, I've heard is doing really well. They are basically like sweep up all the users who previously could not have been served by a single provider because these are the long tail of countries like Egypt, Bangladesh, Morocco. But with stablecoins, you can now like have one unified rail to serve all these users, and I think that's like another sort of like MAU growth vector for PayPal. And then if you can tie that all up in the middle with stablecoins, you also get this like big boost in operational efficiency. And to me, it's kind of a no-brainer. I'm sure Re.Pay is pretty cheap on a relative basis, for PayPal to acquire. So they should go get a bunch of these companies.
On the Christmas shopping list, Anthony Yim always looking to make a big move. I wanna pivot actually now to something that Time and Simon talked about was stablecoin payments. So we're gonna jump ahead here, but stablecoin payments. This is data that actually Artemis released with over 40 partners this past year, showing the stablecoin payment landscape of P2P, B2B, card, B2C, and pre-funding. And right now we're at only about $10 billion of monthly payments. So that's about $120 billion annualized. But yeah, like kind of like Simon, you alluded to, very small fraction of overall payments. And it was actually kind of combining two questions here. How do you think this gets to, $1 trillion a year? Or is there any features right now that are holding companies back from doing payments on the blockchains? They don't have this like killer feature like chargebacks or things like that. Very curious, Simon, your thoughts on that.
I think there's like 1,000 paper cuts. I don't think I'd put it down to one killer feature. It's just like, how does this talk to my existing systems? And how will my customer use it? And where does it fit inside my app? And what does that do with our mainframe? And can my vendor support it? And can I screen this for fraud? And what about sanctions? And you could just go down the list of hundreds of different questions. We had Luca from Cross River on a couple of weeks ago, and they're a bank now that has just gone deep into the orchestration space where if you're a client of theirs, you can send money via stablecoins or ACH or wire or anything else. And to them internally, it looks just the same. And they're kind of at the forefront of that. I think they're right at the front of people who have really reorganized their internal stack entirely around it. Because if you think about the vast majority of stablecoins users today, they're using a third-party orchestration platform who's using a wallet provider and a custodian and liquidity providers, and like they're hiding a lot of that stack. And they may have partnered on the back end as well for on and off ramp providers around the world. There's a lot of complexity to running this business that just doesn't get seen for a lot of people in those numbers. So we've solved some niche use cases for where stablecoins really work, but we haven't necessarily taken the mainstream because it just takes time and it's hard. So it's not surprising to me that the B2B use case is probably the fastest growing, because that's where the juice is worth the squeeze. Whereas in P2P, there are probably better products. So we'll start to see that inflect. I don't know if there's one killer feature necessarily.
So a lot of these blockchains maybe have a possibility of success by switching on a few features, optimizing towards something, maybe a payment use case, maybe a P2P use case. Or
I think it's bigger than any one blockchain, right? Like as much as Tempo will have, I believe, the highest quality of life for any blockchain developer, that's awesome, but it's not the only answer. I think you also need a whole market that knows what minting and burning is. Pretty much every conversation I have with somebody who's been in payments forever is they just want to grasp the fundamentals first. Like, why is this different? Like, from how's this different to my PAX messaging in ISO 20022? And show me the flow of funds from that customer message to the PAX 002 to the recipient of the 008. Like, what happens on the minting and burning underneath that? And does that sit in an omnibus account? And why? And what does that mean for my capital treatment? And where do you bring in the sanction screening tool? So the question is almost less about the blockchain and more about, like, just imagine there's a bubble called a blockchain over here, and now think about their internal, all the things they've got to do. That's where the work is. And I think that's going to happen over the next sort of 12 to 24 months, that people are really going to get their act together on a lot of that stuff. The neobanks they're coming in a big way. You know, what's your Nubanks, your Revoluts, all of these types of companies, your Ramps, they have announced doing something, but they're getting their wheels in motion now. Expect other payments companies outside of Stripe to get their wheels in motion. And then, of course, the financial institutions, the sponsor banks and everybody else. That's going to be an unlock, is we get these major institutional on-off ramps. And this just becomes another product they offer and a better rail for their customers who want to accept stablecoins or move money 24/7.
Yeah, I think that's well said, and it's interesting to see how quickly B2B is growing. You know, despite not really having privacy, which is one thing that comes up in a lot of conversations with large enterprises and corporate treasuries, and not really having great like ERP integrations. And so my hypothesis would be a lot of the B2B, it's smaller mid-market businesses, emerging market where it's that much better than their existing solution that they're willing to onboard new infrastructure providers that might not have like very tight integrations into their existing systems. And when you're a smaller company, you can figure out how to do it. There are not many, if any, Fortune 500 treasuries that have publicly, really started moving significant value on chain. In terms of B2B payments, maybe I guess technically PayPal has publicly, paid some suppliers in PYUSD. Starlink is one of the, SpaceX, one of the most publicized use cases for their own, corporate treasury, but they're not many. And so I think if you're seeing this early growth, it points to like there's something here for B2B. And over the next 24 months, when many of those integrations happen that Simon mentioned, I think we expect to see B2B continue to grow very quickly.
Yeah, that absolutely makes sense. Let's totally just shift gears here and let's go into DeFi because why not? So actually, so here's a trivia question. Over the last 30 days, what application on all blockchains do you think had the most stablecoin transactions?
I already looked at the deck ahead of time. I actually flipped through, so it's but I don't think most people would have predicted.
No, not many people would have predicted that Polymarket is the top application on Polygon with almost 40 million transactions in the last 30 days. You can see here that we're looking at a chart right now of spot volume of Polymarket and of Polymarket versus Kalshi actually, and trending downwards until the middle of the year where it just, absolutely explodes. I don't really have a question here, but I'm curious. I'll throw it open to anyone. It's just fascinating to me that you can, in one conversation, you can have a discussion about stablecoins powering B2B flows, ERP systems, and then you can bet on if Zelensky will wear a suit in 6 months. So maybe I'll throw this to Kai. How do you think of this, ever increasing, financialization of everything that's like driven by stablecoins is the underlying, root of all of these things. Curious how you think about this.
I'm still a bit distracted looking at the slide when I see Pancake Swap is number 3. And just how to explain that to institutions. There's an application called Pancake Swap on the Binance chain, that is apparently the third largest on-chain application, and like it's a decentralized
People
exchange.
like pancakes. I mean, you can't put it past them.
The branding in crypto is just it's sometimes leaves a lot to be desired. But I think with Polymarket, it's clear that there's a lot of interest in prediction markets, both from like a bottoms up, consumer standpoint, and a top-down institutional interest. We saw ICE, the company behind the New York Stock Exchange, making an investment in Polymarket. It seems like every week there's a new announcement of a Kalshi integration. Really interesting to see the Polymarket versus Kalshi battle. It seems like those are the two largest players by far. What I don't understand enough, and maybe one of you could correct me, is I understood Polymarket was just kind of always built as like an on-chain application on Polygon, and it always used USDC. And so it just, as Polymarket grew, USDC would grow, and that was just how it was designed. I didn't know of is Kalshi 100% stablecoin enabled on the back end? Or I thought Kalshi was more like Web 2 off-chain, but you could fund it with stablecoins. And so it seems like there's some distinction in the amount of on-chain activity between Polymarket and Kalshi, which may not be directly correlated to the amount of overall activity on the platforms. And then you kind of get to the question of, okay, well, what problem did stablecoin solve for Polymarket? And why did they build it entirely on chain while Kalshi didn't? And then if Polymarket's one of the biggest users of USDC, are they going to create their own stablecoin? How does that evolve if this continues to become, Polymarket is this major on-chain application?
Yeah, that's we need to add more stablecoins to our first chart. Is really just kind of the takeaway of this entire chart. And then the other, the thing I want to get into, this is actually from the Visa on-chain dashboard here, is that, lending markets have really sizably increased. In the beginning of the year, we went from about $10 billion in loans outstanding to now we're sitting about roughly in the $25 to $30 billion range. I know Simon and Kai, you both have written about Morpho. Kai, you hosted a session with Morpho a while back, but I'll start with you, Simon. How do you see this lending market evolving over time? Because clearly we have, a lot of these are uncollateralized loans that people borrow to buy other crypto out. But clearly there's a huge and enormous design space here. So what does stablecoins via lending solve, and where do you think the opportunities are going forward?
I think it's much easier private credit for neobanks. So if I was a neobank that did not have a banking charter, did not intend to use my balance sheet for lending because I wanted to maintain a technology company multiple rather than a lender multiple, and I wanted my primary activity to be payments, because payments companies that are technology businesses have a great multiple. Lending businesses do not, and they often struggle. Pure play lending businesses can be very difficult to operate. One way around that is if you do lending, you get, you set up a securitization desk and you just sell forward flow. So, a Ramp, a lot of these companies, they will go work with banks, but private credit funds, and they'll go secure a big line of credit, and then they can use that to lend to their customers. So they're not actually doing the lending off their balance sheet. That is very, very hard, very expensive, and very slow. And so now what you're seeing is this alternative model for neobanks where they can just have this off-the-shelf product almost that they can drop into their application that gives their customers yield on one side, but on the other side lets them borrow potentially if they're enabling that product. And so there's a lot of flexibility there. There's still some commercial deals, there's still some risk to be built, but I think the neobanks are looking more and more at this as we don't have to do the classic lending model that people always thought banking would become. There's a much narrower version of a bank here that we could start to build out in the future. So I think that design space is really, really interesting. These markets almost bring private credit and that lending market towards the developer in a really fascinating way.
Yeah, no, it's and now anyone could tap into this market. We've even seen Gabe AI companies like that selling, tokenized GPU stablecoins. So it's almost like how creative can you get with stablecoins is really, what you can bring to the market. Kai, curious, because I know you hosted Paul from Morpho at an event a few months ago. I would love to hear, kind of like a recap from that, and how do you think that fits into the overall trend we're seeing here?
I still hate the term DeFi. Like I don't think it resonates well with banks or with regulators. Like the point of having everything decentralized in a mainstream lending ecosystem, I don't think is the right fit for a lot of regulated institutions. I just don't really think it works. And so we like to say on-chain lending or on-chain credit, where there are benefits of the technology and the ability to build protocols that can connect lenders and borrowers, but you don't necessarily want everything to be decentralized, by definition for some of these things to work. I think that the metrics in how you measure this, it's really important, and this is one of the things that we've tried to do, and the impetus behind kind of putting some of these charts up of, traditionally in a crypto world, like the most common metric to measure DeFi is this concept of TVL, or total value locked. And we found that doesn't really resonate when you talk to traditional institutions. Like, what does that mean? How is the total value locked grown? Like and so what we're trying to do is to say, okay, well, if you think about on-chain lending as a use case for stablecoins that leverages the programmable nature that they have, and the ability to use smart contracts, how much lending is happening in terms of what's the volume of stablecoin denominated loans that are being originated and dispersed on chain through smart contracts? I think that's the right question to ask and the right metric to really follow and analyze. And so that's what we've been doing. And I think when we show this metric, and so just in 2025, having over $200 billion of loans originated and dispersed in stablecoins, that gets a lot of people's attention. Like, whoa, like this stuff seems to work. The technology of smart contracts is working for representing this type of a lending arrangement. But then there are a bunch of questions, and a lot of the questions being, okay, well, 100% of this is basically crypto collateralized. These are entirely permissionless pools that anyone's like lending or borrowing from. And so there are a number of major challenges and obstacles for on-chain lending to move from DeFi crypto native to mainstream finance banking. But I think the technologies and the protocols that are really innovating, becoming more modular, having more kind of permissioned capabilities to know who's lending or borrowing, having more data standards to do underwriting that might not have to be fully collateralized. Like, all those things are developing. And so I think we're still at a very early stage, and the primitives are starting to emerge. And now the question is, how do they become more adopted in traditional lending environments? And like that's what's going to be really interesting to watch going forward.
Yeah. So as we get all of these different things that we have in traditional lending markets, we'll be able to grow much faster because we have things that more financial institutions are comfortable with. And the last few minutes we have, I wanted to see. We'll make a few predictions and see what's in store for 2026. Anthony Yim, I will first ask you, because you have so many HD DVDs and, we're forever burned by the adoption of Blu-ray technology. Right here, we're looking at X402 daily transactions, and they've been increasing pretty quickly. And as this theme of agentic commerce slowly gains traction, Anthony Yim, questions for you is obviously it's still early, but do you think we're still early to predict a winner in this protocols of X402 versus OpenAI? And do you think that stablecoins are really best suited for handling agentic commerce?
Yeah, I mean, to answer the first ones, I definitely think it's way too early. I think we're in the like HD DVD versus Blu-ray battle where it's like, it's too early to pick the winner. I just like that little throwback because I feel like I completely forgot about that battle, but when Andrew and I were, as millennials, reminiscing on our 20s, we realized that that was a thing for sure. And so I think we're in this moment. I'm excited about agentic payments. I think that will be a thing. I was just thinking about like, hey, I really want just like an agent to decide what my meals are for me for this week, based on my analytics, like my health, how often I went to the gym, my sleep, like all that stuff, and just like offload that for me, and it just buys my Uber Eats for me, and I just have to approve it. Wonderful. But like, which one will win? I don't know. I think it's way too early to tell.
Yeah, that makes sense. And then finally, one thing here is we briefly talked about how USD stablecoins have been totally dominating. Right now, we're looking at about $600 million in supply of non-USD stablecoins. Well, that's grown a little bit year over year from about 400 million to 600 million. I will note that that is almost entirely euro denominated. So if you look at the non-USD fiat stablecoins, almost 90% of it is actually in euros. So Simon, throwing it over to you, what do you think is holding us back? Or is this really, truly everyone wants dollars? Or do you think there's a lot of infrastructure that needs to come online to really boost this number?
Yeah, I think everybody wants dollars and dollar treasuries in particular. So the problem with the euro is there isn't a mutualized debt market. So you can't back a euro stablecoin in quite the same way. You have to back it in cash. So the yield performance doesn't look the same. And right there, you've killed one of the key benefits of stablecoins is they're this cash-like asset that I can move instant 24/7. And I get this extra yield that I would have almost from a money market fund if I'm the sub-issuer of it, like a Klarna USD, or if I'm the neobank or something along those lines that's got a distribution partnership with Circle or things of that nature. So there's really no lack of demand for last mile stablecoins. I think it's the obvious thing. There's just a lack of an incentive to be able to do them. And there's difficult regulatory regimes, frankly, to be able to do them. Whereas the US now has a lot more clarity and it had a lot more momentum historically. I do think this will change in time. I actually think, weirdly enough, the consortia of European banks called Kivalis could be an interesting one to watch. And if we start to see the euro as like an actual solution for just a European-wide settlement that's instant 24/7, because we have SEPA, but it's not instant. In all cases, there's SEPA instant, but the volumes of that are incredibly small. So I think we could see the euro make a play because it's 25% of the global currency markets versus, like less than 1% in stablecoin markets. The euro should have a right to be in this conversation, but MiCA makes that very difficult. The lack of a single debt market makes that very difficult, and that will need to change, and maybe that will take a couple of years. And we need to think about, like, if I'm a new bank, I'm holding lots of MXN and BRL. Like, what do I want to do? I immediately want to get into dollars because I want to hedge out of that volatility. There's nothing there's no incentive for me not to do that. So right now, the incentive structure is kind of backwards. And we need truly liquid, deep on-chain FX markets. And we're a little ways off that at the moment.
Yeah, very nicely said. So in the last 2 minutes that we have the most controversial or even a single prediction for 2026. Anthony Yim, you are first on the list. What is your prediction, sir?
I think nature will heal in the sense that there will be a bunch of actually stablecoin blowups because of two things. One is that we talked about this earlier, like they're not actually stablecoins, and people find out the hard way that, if you sell something as a stablecoin, but it fluctuates, it might erode confidence. And I think of this because, like, we get pitched a lot of stablecoins all the time to be added to Artemis as like a neutral data provider. And a lot of things I'm like, that's not a stablecoin. It's not very stable at all. And so I think because stablecoins have such strong product market fit in crypto. Like every now crypto founder is like, oh my god, I need to launch a stablecoin. It's like that way I can build a company. And it's just a lot of these things are not stablecoins. And so that's one thing. And then another one is that I think people will realize some of these founders who are launching, fiat-backed stablecoins maybe underestimate the amount of how hard it is actually to get real volume and real liquidity. That's a really strong moat that is hard to penetrate from Tether, and also from actually now the incumbents are coming in, right? Like PayPal, Stripe. These guys have real users. They own the end customer. That's really, really hard to snatch away. And so, yeah, I think a bunch of these guys won't make it. That's kind of a more somber prediction, but I think overall it's good. It's like nature's healing. We will stablecoins will continue to grow, but some people will have to learn some hard lessons.
Yeah, power laws are a thing and Darwin exists. Andrew, I want yours, though. I want your most controversial prediction. You seem
Okay,
like
here
a
we
man
go.
who can do
Here we go.
controversy.
I think Binance will buy Circle next year. And the reason why I think that is a few things. One is if you look at the data, Binance, the USDC is going to flip where Binance is going to be the number one holder of USDC versus Coinbase. And actually USYC, Circle's tokenized money market fund or tokenized treasury fund is actually now over $1 billion, where 95% of it sits on Binance. So I'm predicting some very high class drama with maybe Circle Coinbase, and Binance, swoops in and buys them, and it's just going to be a fun 2026. And also tokenized gold will also be. We'll have to pivot this show instead of stablecoins. We're going to be talking about tokenized gold. Is my crazy predictions for 2026.
That's a great place to leave it, because Kai and myself will be doing a full prediction show, which will be the next episode in your feed. But thank you guys so much for taking us through the year in review, the year in stablecoins, for having actual slides and charts. I feel like, we got to up our game, Kai. We're going to have to start doing some real work for the podcast, not just relying on show notes that Petrit produces. Like this is the A game here. Really appreciate it. Look, if people want to find out more about Artemis or what you're doing, Anthony, where do they go to do that?
Yeah, they can find me on Twitter or X at Anthony Yim, and of course also at Artemis for our company.
Andrew, if people want a coffee or they want to talk to you, where do they go to get that?
They can just follow at Artemis. I'm, doing a lot of the messages there. Sometimes I answer DMs, so it's all about playing for the team.
Heck yeah. Kai, how about you?
On X at Kai Sheffield and visa.com/crypto.
You'll find me at SY Taylor on Twitter and Simon Taylor on LinkedIn, fintechbrainfood.com and tempo.xyz. If you haven't already subscribed because of the data show, then go ahead and hit the subscription button right now. Leave a like, leave reviews, do all the things that hosts bug you to do. And please tell one friend today about this show, just because you have Andrew's soothing voice. Like, that's the reason you need to be into this. It's just pure ASMR. And I'm glad we got to do this. Thank you so much, and we'll catch you next time.